All right, good morning, everybody. Made it to the end of the week. So we're running at a mixed bag. We got Europe down, US mildly down, but basically flat, and Hong Kong mildly up, but basically flat. We're just holding the line, other than Europe's weakness, waiting on data. And we have a lot of data. So some of the data from Thursday was put into Wednesday's market, and then some of it went to today's. But one of the biggest issues for today is the non-farm payroll and the unemployment numbers. They're really wide. I mean, this is a better number than I've heard bandied around this morning. I heard between 120 and 220 or 230. This is massive. So, they talk about how smart and how much money the big firms have and their edge over retail because of all the data at their fingertips and being able to hire experts that can parse the data and really get good insight. I could probably get better prediction numbers from the kid who sacks my groceries. There's absolutely no idea what's going to happen when we get the jobs data today. And if they don't know, well, we sure as heck ain't going to know. So it's very likely they're just going to hedge it to the hilt. We'll get some big swings in each direction and it'll settle back down. And we'll get the gap closed really fast. We're talking about a liquidity gap, not a price gap. Once we're done with the job numbers this morning, we'll move on. We're going to get consumer sentiment at 10. And then at 3:30, we'll get some more information, but that late in the day, I don't think this is going to be enough to change anything. If we're bearish or bullish at that point, this won't be enough to adjust sentiment. We've got OPEX next week. It's options expiration. It happens on the third Friday of the month. It's never a surprise. You can see it coming. And the line in the sand for the SPX is still 59 on the bottom and 61 on the top. So that 200-point range is where the options structure is into OPEX. So you want to continue to watch those levels to see if they thin it out on the top side or the bottom side. Just keep in mind which edge is closer to us. This is VWAP or volume profile for the week. This weekly profile offers us an opportunity to see not only our current week, but the previous weeks. And if we line up with their points of control from those previous weeks. And we've been building this structure here above 59. And we can see that if we start to break down from there, we really don't have much until we get under 58. So 58 and a quarter, maybe a little less than that. We've got some structure back here from the end of October and the first week of November. Otherwise, if we look for a flip and we're thinking about a run back up, this entire range is a part of the band that we're in that we have to get out of. That gets us up to 6,000. And a break above 6,000 has a point of control at 60.20. That's from a few weeks back. And then the value area high, 60.18. If the data is not bad today, I think we go after this weekly floor pivot, 59.65. The idea would be that we can get above it, and when we think about how far above it, I would look for reciprocation. So however much we got on the downside, that's the minimum I would expect on the upside. Guess it's right into 60.11. Imagine that, a cog line. Today's floor pivot is lower than yesterday's. That's bearish. Price opened above it. That removes a little bit of the bearishness from it. We cut down below it. Now we're just crisscrossing it back and forth. These pivot points won't come into play while we have economic data. So something like non-farm payrolls, it'll run over any pivot point that you have. Yesterday's high, low, the week's high or low, none of that will matter. It'll just run right through it. VWAP pivot points, volume profiles, it won't matter. So we got to get through the jobs data first, see it settle out, and then move forward from there. It is a narrower channel, which implies if we do break out, that it can grow legs and really run. Now, that's not as narrow as we've seen it could be. It can be so narrow you don't even see any lines other than the purple one. But it is a more narrow channel than, say, Wednesday's channel. When we look at the ADRs for the day, we're basically flat, which we knew because we can see we haven't really gone anywhere today. We don't have much edge in trying to anticipate if we're going to go to the upper one first or the lower one first. To get to either side, we're going to have to break outside of yesterday's range, yesterday being Wednesday. So we have to get an inside day breakout just to get to the ADRs, which a lot of times this isn't true. A lot of times at least one of those ADR lines will be within yesterday's range, making it easier to hit. Not today. Even with the compressed day that we had Wednesday, it didn't decrease our average range. We're still looking at 1.4% as an average daily move. And you can take that 0.7 higher, 0.7 lower. That's your 1.4 on the day. And we have a market maker move, which tells us they're spending additional money to hedge for today only. On top of the normal hedging that they already have, they're spending extra money to hedge today. So all we're looking to do here is stay above 59 by the end of the day. The markets kind of need that if it's going to keep this structure in place. Otherwise, if we break down below 59 and it looks like we won't close above it, it's very likely that they'll feed into it and really bleed it to the downside. If we can hold the line and close here into the end of the week, it's very possible that we can resume the structure that we've been building here and try to put in a new high next week. If not, then we start getting into the idea that we could wash it down into 58, get a nice reset, and then come back out of this. If you look back through history, there's been periods of time where we spent a year going sideways, a year and a half going sideways. So this doesn't owe us some run back to the top and a breakout and continuation through 2025. And just because it doesn't owe us a continuation higher does not mean we have to break 5,800 and start selling off lower and deeper. We can sit there and chop for months, wicking a little lower than 58 and coming back in, and even peaking out above 62 and coming back in, and just spending a year and a half to 2 years there. I know that's not what anybody wants to hear, but price can do whatever it wants, and it doesn't have to make advances or breakouts. But this range is the structure that we've got to deal with. And if 59 doesn't hold, we're going to deal with 58. But on the day, trying to identify, what we could do versus what we should do. We should maintain the line, even if it's negative. This is more of the negative side than the positive, that we close in the day, even if it gets negative, that we drop down, cut below 59, maybe even get a full ADR. But by the end of the day, we try to rally back at least into Wednesday's range. Because if it doesn't, that sets us up for Monday and some real negative stuff. For a rally back the other way, you really got to kind of argue what would get them in here buying a week before non-farm payrolls, OPEX, right? So if we're going to have OPEX next week, what's going to get them in here buying this and getting us through the upper ADR, challenging Tuesday's high or Monday's high and trying to break out on the week? I don't think non-farm payrolls has the juice for it. We'll see. It was just the projections are too wide for any consensus to have that sort of power. So if we get bullish with exuberance behind it, the target is the ADR half first, then the ADR full, then Tuesday's high. Look for a continuation above Tuesday's high through 60.50, and then Monday's high. Getting to Monday's high would be more than enough. But if we do get a breakout above it, 60.85 is the line in the sand. You can see my previous line there already. 60.85. So that's the bullish case for the day. If we break down and things really start to get ugly, we've got last Thursday's low, then the full ADR, and then 58.25 is my lower edge for today. It's more likely that we hold the line than the idea that we push either one of these edges, but we'll see. Still waiting on spot gamma's report for the AM. But we are at the put wall. We're under 0 gamma and we're under the volatility trigger. If we drop down below yesterday's low, there's no options structure to help us out until we get down to 58. There's just nothing down here. For the SPX, that would be 59, right? Because the numbers are a little different. So we kind of need to hold this put wall. We got to keep it. Now we can wick down below it. That's not the issue. We don't want a sustained run underneath that put wall. And we got a little bit of that last night before Europe stepped in and helped us out. So we're back above the line. But Wednesday's low is the keeper. Now we can put quadrant lines on that and extend to 111. That would get us around 59.11 cog line, or this voodoo line down here, 59.14. I like 59.11. If 59.11 fails, then we've got 5900, which is the ADR half. But we can't look for the put wall or the volatility trigger or 0 gamma to step in and help us out at this point. And I think if we get below 5900, it'll be the DEX and the dealer gamma that becomes the issue, right? They will sell into that selling instead of trying to buy into the selling. And then we can wash really fast. The point of control is now lined up again for the TPO, which is the blue profile, and the volume profile, which is green. We've got agreement around 59.50-ish. This is now the zone that we can hang out like a zipper, just back and forth without really getting anywhere. It won't be considered any sort of support or resistance unless we leave the range and come back to it. Much like we did back here when we were holding within a range and we left it. When we came back to it, it acted as a support. It wasn't able to keep it. We finally broke underneath it, but the idea behind it. So as long as we're holding around it, we can go up and down through it, and we won't consider it supportive or resistive. We have to leave the range again. If we look at what we're going to be losing on the left, the profile where we're at is only looking like it's going to get bigger and stronger. So this is likely going to be our point of control for at least a week. We'd be in a better position if it was going to be fading out so that it would reduce its magnetism, I guess is a good enough word. But it's not going to be fading out. Looks like it's going to be strengthening. So I guess we just have to get comfortable with it at its new spot. Still no new VPOC here. We look at what we had Wednesday now into today, the points of control that just overlapping each other because we haven't done anything since Tuesday's low. We're basically in the same spot. So it's been a sideways week with the mandate of holding the line more than trying to actually get anything accomplished. The market made some really big moves after FOMC, and then we've had short weeks, holidays, all of that. It's just trying to digest the data and heal so it can make its next move. So we just got to hold the line. Back below the 10-week, but barely. We'll continue to hold around this 10-week until we get enough news one way or the other that gets us away from it. Like gravity, we're just drawn into it, and now we're cycling around it. So at this level, it's not bearish, not bullish. It's just not bearish. We've gone deeper than that before getting a nice turnaround and coming back. So we're not oversold, certainly not overstretched. It doesn't owe us any move to the upside based on the 10. Now looking at the 10-day, we've spent a considerable amount of time now under the 10-day. Just like everything else, if we're thinking about reciprocation, once we've made the move in one direction, it's likely that we make the move back in the other direction. This is why we don't short the whole, right? If we're already down and we've been falling, it's more likely that price pops up like a dead cat bounce or a bounce off support with a run into resistance rather than just breaking down even further. But keep that phrase in mind that we don't crash from an overbought position, right? We crash when we're oversold or we crash from the lows. So we are under the 10-day. We've been holding this level for a few days, and if we can't keep it, it's likely that we get a crash down from here, like a flash crash. And that would fit with the scenario that says we don't flash crash from the highs. Because it's Friday, we have next week's projected range. This range can change. It's not set in stone like all these other ones. It won't lock into place until after 4:15 tonight. So looking at it this morning, it's just a glimpse of what it could be next week. It gives us some idea of what is being priced into the market or even priced out of the market. So this is the week that we have currently. We can set it on next week's range, and we can see that next week has, so far, more volatility priced into it than this week. But that's a little misleading. This week was a short week, 4 days instead of 5. The range is based on time and volatility. So if next week has 5 days and this has 4, well, then it has more time. So the range is wider. And that would be based on the idea that it's not necessarily more volatility, it just has more time. We'll visit this again on Monday and see what it did lock in after 4:15 today. And if we were looking for that capital rotation for a rising tide in all the boats, we didn't get it. But tech is down on the lower end, so we'll be looking for this to get supported. Finance down on the lower end here, although I've seen some negative stuff about banks this morning. And we're getting close to banks starting the new earnings season. They are near that supportive structure rather than being, up at highs looking like they're going to break out. And consumer discretionary with that little micro pattern there. So those three could try to get a little bit of a bounce today if the news is positive, and that lines up with building materials and industrials. Even a bit of a dead cat bounce on XLP is possible from this position. Everything except healthcare, which already had a start on that run up. This would be more of a breakout play. Whereas a lot of these others are just a rebound off of the lows, like utilities here. Energy, the same thing. It already had a run up. IX10 now. It would need to break above, well, the round number 88 first, and then get out of those other two wicks if we want to get anything in this. A lot of sellers present. Looks like 88.5 area. They're just front running 88.5. There's been a lot of back and forth over the last 2 days about NVIDIA's CEO talking trash on those quantum names. And then a lot of quantum CEOs came out, started talking trash on NVIDIA. And so Market Watch and a few others, they've wrote some articles about how after hours Wednesday, the quantum names started to get a bit of a run to the upside. Now they're saying it's likely we see a bit of a rebound in those quantum names. Maybe, but most people are going to be looking for an exit. So if we do start to get some sort of rebound play in those quantum names and you're upside down in your position, you may be thinking about fading the exit, right? That's a significant drop. The heck of a haircut when it goes from 20 to 10. That's 50%. Even if it gets a minor bounce here, it's very unlikely to get through the candle from Wednesday, which is what, 13? And I just randomly picked one, but pretty much all of them look this way. Will they come back? Your guess is as good as anybody else's. I'm just pointing out that if you do see them start to pick up some juice today and they're getting some upside flows, just keep in mind they'll try to get out of it on those pops to the upside, right? We say it in a way you may recognize: sell the rip, not buy the dip. This is the article that I had read yesterday. It's Benzinga Newswire, where they were talking about quantum stocks are poised to open higher because basically those quantum CEOs came out and started trying to walk back what Jensen said. Maybe they get it done, maybe not. I don't think they're going to get it done on Friday, but maybe they can stop it from bleeding as a good starting point. And remember, it wasn't just quantum names. Drones got whacked. Uranium, all the speculative plays from the last 6 weeks. So we got China down, the China ADRs. So Baba, Baidu, JD, PDD, all those guys. Airlines are up against all reason. They're up. Delta Airlines CEO was talking real good about 2024 and projecting some nice comments into 2025 and how they're poised to really make money. The market liked that. So that boosted DAL, AAL, UAL, jets. They're all getting a bit of a lift. We got gold miners, Bitcoin. Now, I get it. If you don't trade Bitcoin and you don't like Bitcoin, well, I mean, you're not alone. I think it's about a 50-50 argument on the people that like it and hate it. But it'll still offer you plays. So when you see Bitcoin up, Baba, Baidu, PayPal, NVIDIA, AMD, Square, but also your more simple ones: Riot, Hut, Mara, Coin. those Bitcoin proxies are going to run if it's running. So on the intraday, it at least gives you something to focus on, are those Bitcoin proxies. Crude's still looking good, even though a lot of the energy names aren't looking good. They're up a little bit this morning, not enough. Oil and gas exploration, I mean, is up a little bit. Oil service, OIH. Crude's doing good. A lot of those energy names are not. So they're getting a little bit of a bump, but I wouldn't get too comfortable with them yet. So we can see crude with that big move to the upside starting to get a little bit out of control. Nat gas is still trash. So it's sitting up here this morning, but it's already started to bleed a bit. And then jets. I mean, you got to admit, that's pretty impressive for, trash companies that can't manage their money well. That's looking pretty good. Pot stocks, it says it's up, but all we can see are these little algo prints. It's not really getting any flows. Same thing with gold miners. Really nothing here, just little algo prints. Got to get some flows in there first. Home construction, same thing. No real flows. Now gold's getting a little bit. It's actually been putting in some candles up there, but it needs to hold it. And that's a significant gap up. Kind of leaves it just hanging out there. All right, it says Bitcoin is up, but if you look at this and how it closed, this isn't looking very strong, and it's not up by much. Certainly sitting inside of Wednesday's range. We need to get an inside day breakout at least if we're going to get anywhere in those Bitcoin plays. So like energy here, it's completely outside of Wednesday's range. Even Tuesday, that's new highs on the week. All right, we still got the TNX sitting way up here. This is an issue that we got to see resolved soon. It'd be something I'd say pay particular attention to today. We don't want this breaking out and going higher, and it would be better if it started to work its way down, but we don't want it making really fast moves to the downside. Nice and easy, no wild and extreme movements, right? Even though we want this to go down, we don't want it to be crashing and burning to the downside. So the candle is filled in because it opened way up here and then it fell down and it's down here. If this starts to move to the downside, say we get back below 4.68, we should see a little bit of relief in the markets I'm not saying that we'll, rally like crazy, but it's likely we'll stop falling as much. This should tie in with tan or solar. The bonds should get a nice move off of support. But if this breaks out above 4.7 or whatever this high is, 4.716, I think it's going to get a lot worse in the market before it gets better. So definitely keep your eye on this. That's your swag level to the upside. I'd use 4.68 on the downside as a level to get under to start seeing a little bit of relief. If we get that breakout higher in yields, look for the VIX above 20. That'll tie in with things getting worse in the market. So we want yields to start falling, then get SMH moving back to the upside, get an inside day breakout. Preferably something like NVIDIA or one of the other big dogs trying to run with it. Get the MAG 7 at least holding the line and looking to the upside. Then we just need the option flows to come in and we can run the S&P and the NASDAQ up. If we don't get that and the 10-year just stays sideways, it's very likely the market will too. We'll just hold the line into the weekend. So watch the clock, keep your eye on the news. Hope you all have a good weekend. We'll see you next week.